Hello there, I'm your host Leelaa Rao, welcoming you to your fortnightly program, Invest Wisely, your ultimate gateway to safe and intelligent investing. I wish to start this program by wishing the viewers of TV Asia a very happy and prosperous Deepavali. May Goddess Lakshmi bestow on you everlasting wealth and well-being. Coming up in this session, commercial real estate, is this right for you? Be it the Donald Bren, the richest real estate tycoon in the world, or the flamboyant and popular real estate magnate Donald Trump, they made their riches in commercial real estate. Today, we'll explore the nuances of commercial real estate from an investor point of view to help you choose if this is going to be the right investment for you. Following that, evaluating commercial real estate and alternatives to owning real estate directly. If you overpay, a good investment may turn out to become a bad investment for you. Let's get an overview of how to evaluate commercial real estate to help you make an informed investment decision before you sign on those dotted lines. Also, we will look at alternatives to owning real estate directly and avoid the trouble of maintenance. And finally, in question time, we will discuss some interesting emails by investors. Commercial real estate, is this right for you? Real estate, akin to any other investment, comes in different categories. Normally, when people are thinking of real estate as an investment or for generating income or cash flow, end up buying residential rental properties in the form of single-family homes, condos, or townhouses. People best suited for investing in commercial real estate are those who either have a considerable amount of knowledge about the industry or have hired people with expertise in the field. Now, I know what you are thinking. You are thinking that such investors are likely to be already quite wealthy to start with. No wonder some people think that commercial real estate is a suitable investment only for the gutsy class of investors. And others think this category of real estate investment is only for the affluent class of investors. In reality, there is very little truth in both these schools of thought. The present-day tycoons of commercial real estate had very little capital to start with. This is because there is a wide range of commercial properties from mammoth malls, office towers, and shopping complexes down to small warehouses and single shop buildings. So you don't necessarily need to have a lot of capital to start with. All you need to do is make sure that you can cope with the time and costs related with an investment in commercial real estate. Now let us see what are the advantages to investing in commercial real estate. One of the greatest advantages of commercial real estate is the attractive leasing rates. In areas where the amount of new construction is either limited by land or law, commercial real estate can have impressive returns and considerable monthly cash flow. This is because there is a greater demand relative to the supply in such areas. Rent depends on factors such as location, type of usage, and overhead costs involved. For example, industrial buildings generally rent at a lower rate, but they also have lower overhead costs compared to an office tower. By and large, rental rates are calculated as price per square foot. The second advantage is commercial properties tend to have longer lease contracts. Typically, residential leases are for short-term periods, often as short as 3 or 6 months, or maximum up to a year. However, it is not unheard of that some commercial leases last for 10 years or more and are usually at least for a year long. This gives a commercial real estate holder a considerable amount of cash flow stability as long as the building is occupied by long-term tenants. The third advantage is that commercial mortgages are usually non-recourse. Hence, owners of commercial property have an easier time walking away than residential property owners. That means the biggest penalty for walking away is the forfeiture of assets and cash flow they may generate. I would like to draw your attention to a recent article in the Wall Street Journal, which stated that several top commercial property owners, such as Mace Rich Company, Vornado Realty Trust, and Simon Property Group Incorporated, stopped making mortgage payments. This is not because they did not have the resources to do so, but because the value of the properties they purchased were underwater, meaning their value had fallen to a level less than the debt owed on them. The fourth advantage of commercial real estate is the benefit of claiming depreciation on the property owned. While land is not depreciable, you can record an expense each year for the wear and tear on your building on a straight line basis, and this reduces the taxes paid to the IRS. While talking about the advantages of commercial real estate, I wish to introduce a term called defeasance. Defeasance is an excellent advantage for commercial real estate owners. Commercial real estate investors who favor fixed rate debt financing occasionally find themselves having to pay prepayment penalties when they settle their debt in advance of the maturity dates of their loans. Of the different prepayment options, defeasance is one that provides the greatest flexibility and potential financial gains when market interest rates rise. Now let me explain what defeasance means in simple words. Defeasance, as its name implies, is a method for reducing the fees required when a borrower decides to prepay a fixed-rate commercial real estate loan. Rather than paying cash to the lender, the defeasance option allows the borrower to exchange another cash-flowing asset for the original collateral for the loan. The new collateral, which is normally treasury securities, is usually much less risky than the original commercial real estate assets. The lender now is far better off because he receives the same cash flow and in return receives a much better risk-adjusted investment. While the benefit of the defeasance for the lender is obvious, borrowers can also benefit significantly. If interest rates on loans rise to a rate greater than those of the mortgage, borrowers can create value and put cash in their pockets at prepayment. Because defeasance is an option offered during the negotiation of a commercial real estate loan, borrowers should consider it in order to preserve the possibility of creating value with their financing. Now, what is the rationale for defeasance? Variable rate commercial real estate loans are an appropriate method for financing short-term needs such as construction or bridge financing, which is capital loan to real estate owners in the lease-up phase. It is repaid when the property eventually has cash flow. Technically speaking, this is more like mezzanine financing. Even though the interest rate risk is high and there is no limit to the financial downside, some borrowers will like to take long-term variable rate financing. This often happens when there is a high probability that a property with a cash flow will be sold before the loan matures. Borrowers use variable rate financing for various reasons. One noteworthy reason is to circumvent the prepayment penalties that lenders require when prepaying fixed rate debt. On variable rate financing, lenders are not exposed to reinvestment risk because the loan rates float with the market and when repaid can then be lent again at the same market rates. Let me tell another important benefit that defeasance offers. Defeasance, unlike yield maintenance, offers upside potential for borrowers when market rates rise above the contracted loan rate. Yield maintenance is referred to as a penalty because borrowers are subject to some type of repayment regardless of which direction market rates move. It is usually structured as a greater of the yield maintenance calculation or a percentage of the amount prepaid. Because defeasance requires the purchase of treasury bonds, the movement of rates directly impacts the cost of these assets and impacts whether defeasance will be a cost or a windfall at prepayment. In most cases, defeasance involves the purchase of treasury bonds with maturities equal to the remaining term of the loan with coupon rates that provide the necessary income to offset the contracted periodic interest and principal payments. These bonds are then assigned to a defeasance trust that passes the periodic cash flows to the lender until the bond matures. When rates rise, treasury bonds or any fixed income investment lose value and become cheaper. When this happens, borrowers are able to purchase the required bonds for less than what is required to prepay the loan, resulting in additional cash in their pockets. Because defeasance results in the exchange of a less risky assets than the collateral, borrowers can keep the same percentage of debt in the portfolio after the sale of an asset. With the agreement of the lender, it may be possible to increase the percentage of debt on the remaining assets when the defeasance is executed. Another benefit to borrowers is that lenders don't usually require any type of payment, either upfront or by increasing loan rates in order to receive the defeasance option. If rates rise, there is a value creation potential for the borrower. Therefore, it is conceivable that lenders could ask for compensation for selling the option. In conclusion, when negotiating loan terms for a commercial real estate loan, borrowers should ask for the ability to defease their fixed rate loans even if they have no intention of prepaying the obligation before maturity. The distinct advantage that defeasance provides over other prepayment options is significant due to its ability to create an income-generating event when market interest rates rise. Now, we also have to consider the disadvantages to investing in commercial real estate. Rules and regulations are the primary deterrent for most people wanting to invest in commercial real estate. The taxes, mechanics of purchase, and maintenance responsibilities for commercial properties are buried in layers of legalese, and not only that, the legal requirements tend to shift from state to state in the US. If you own international real estate, the legal issues and the regulation governing the real estate sector must also be adhered according to that particular country. Another hurdle is the increased risk brought with tenant turnover. In residential real estate, the requirement of a given tenant are almost the same as any previous or future tenant. With commercial property, an office for example, each tenant may have very different needs that require costly refurbishing. For example, if you had an accounting firm as your tenant in the first place and then a law office, they both will only require the same kind of a common area for reception. But if you then choose to rent it out to a physician because he would pay you a better rent, you may have to do several changes to the interior of the building. So as a building owner, you have to adapt the space to accommodate each tenant's specialized trade. When we come back after a short break, I will discuss with you the ways to evaluate commercial real estate before you make your mind to purchase, and also alternatives to owning physical properties. Stay tuned. Invest Wisely will be shortly back after the break.